For financial reporting notes. Module 3, Revenue from Contracts with Customers. Provisions, Contingent Liabilities and Contingent Assets. Part A, Revenue from Contracts with Customers, P.117. Overview of IFS 15 Revenue from Contracts with Customers, P. 118. IFS 15 was introduced to improve the financial reporting of revenue by providing a more robust framework for addressing revenue recognition issues, improving comparability of revenue recognition practices across entities, industries, jurisdictions and capital markets, simplifying the preparation of financial statements by reducing the amount of guidance to which entities must refer, and requiring enhanced disclosures to help users of financial statements better understand the nature, amount, timing and uncertainty of revenue that is recognized. IFS 15 Basis for Conclusions, Para. BC 3. To assist entities in applying IFS 15, the new standard provides guidance on how to account for numerous contract types and their elements, including contracts with a right of return period, contracts providing goods or services with warranties, contracts in which a third party provides the goods or services to the customer, principal versus agent considerations, contracts with options for customers to purchase additional goods or services at a discount or free of charge, customer prepayments and payment of non-fundable upfront fees, licensing and repurchase agreements, consignment and bill and hold arrangements. Scope of IFS 15, P.118. IFS 15 applies to all contracts with customers, except those contracts that are lease contracts within the scope of IFS 16 leases, contracts within the scope of IFS 4 insurance contracts, financial instruments and other contractual rights or obligations within the scope of IFS 9 financial instruments, IFS 10 consolidated financial statements, IFS 11 joint arrangements, IAS 27 separate financial statements and IAS 28 investments in associates and joint ventures, and future payments under employment contracts. IAS 19 deals with this. Non-monetary exchanges between entities in the same line of business to facilitate sales to customers or potential customers. IFS 15, Para. 5. A contract with a customer may be partially within the scope of IFS 15 and partially within the scope of one of the above standards. In such cases, IFS 15 applies as follows. If the other standards specify how to separate or initially measure one or more parts of the contract, then an entity shall apply those separation or measurement requirements first. The transaction price of the contract is then reduced by the amounts initially measured under the other standards, with the remaining transaction price being accounted for under IFS 15. If the other standards do not specify how to separate or initially measure one or more parts of the contract, then an entity shall apply IFS 15 to the contract. IFS 15, Para. 7. Impact of IFS 15, P.119. Entities in the technology sectors were particularly affected, making IFS 15 a prime example of the IASB's response to the various aspects of the recent technological advancements impact. For instance, telecommunications entities may provide customers with a free handset that they can use in return for entering a monthly payment plan for a minimum period. As a result, some telecommunication entities recognized revenue from the sale of the monthly plans when the service was provided and treated the cost of the handsets as a marketing expense, whilst others treated the handset as a cost of acquiring the customer and amortized it over the minimum contract period. Under IFS 15, telecommunication entities must allocate the total contract price between the sale of the handset and the monthly plan. This changed the timing of the recognition of revenue, with revenue allocated to the handset now being recognized earlier, that is at the time of its sale. Overall, the practical implications of IFS 15 are that the timing and amount of revenue recognized from contracts with customers will change for some entities that have been applying previous revenue standards, i.e., IAS 18 and IAS 11 construction contracts. This is because entities will be required to alter their accounting treatment of items such as contracts for bundled goods and services, contract modifications and contracts that are satisfied over time. 3.1 Recognition of Revenue P.120. IFS 15 establishes a framework for determining when to recognize revenue and how much revenue to recognize. For example, Telstra, iPhone and data bundle, phone and data are accounted for separately. The core principle of IFS 15 is that an entity should recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. IFS 15, Para. 2. To meet this core principle, an entity needs to adopt a 5-step recognition model for each customer. Step 1, Step 2 and Step 5 refer to recognition requirements, while Step 3 and Step 4 cover measurement requirements. Step 1, Identify the contract with the customer. P. 121. IFS 15 defines a customer as a party that has contracted with an entity to obtain goods services that are an output of the entity's ordinary activities in exchange for consideration. IFS 15, Appendix A. A contract is an agreement between two or more parties that creates enforceable rights and obligations. IFS 15, Appendix A, and this agreement can be written, oral or implied by an entity's customary business practices. For example, a person buying a home. An entity shall apply the requirements of IFS 15 to each contract that has all these attributes. The parties have approved the contract and are committed to perform their obligations. The entity can identify each party's rights regarding, and the payment terms for, the goods or services to be transferred. The contract has commercial substance, i.e., should influence future cash flows of the entity. It is probable that the entity will collect the consideration that it is entitled to in exchange for the goods or services that it transfers to the customer. IFS 15, para. 9. If the contract does not have all of the above attributes, IFS 15 does not apply, and this must continually be reassessed to determine whether all attributes are subsequently present. Combining multiple contracts, P.122. Paragraph 17 of IFS 15 requires an entity to combine two or more contracts entered at the same time with the same customer and to account for them as one contract if there is the following. The contracts are negotiated as a package with a single commercial objective. The consideration to be paid in one contract depends on the price or performance of the other contract. Or, the goods or services promised in the contracts, or some goods or services promised in each of the contracts, are a single performance obligation. However, if the entity expects that the financial statement effects of accounting for multiple contracts as a single contract will be materially different from accounting for the contracts individually, the entity is not required to combine multiple contracts into one contract. IFS 15, para. 4. Contract modifications, P.122. A contract modification is a change in the scope or price, or both, of a contract that is approved by both contracting parties, and it exists when the contracting parties approve a modification that creates new, or changes existing, enforceable rights and obligations of the parties. Like the contract itself, the modification can be written, oral or implied by customary business practices. IFS 15, para. 18. Modification accounted for as a separate contract, P.122. If the modification has been approved by both contracting parties, it shall be accounted for as a separate contract if both of the following conditions are met. 1. The scope of the contract increases because of the addition of promised goods or services that are distinct. IFS 15, para. 20a. 2. The price of the contract increases by an amount of consideration that reflects the entity's standalone selling prices of the additional promised goods or services and any appropriate adjustments to that price to reflect the circumstances of the particular contract. IFS 15, para. 20b. An example of price adjustment is when discounts are given to customers. The existing contract is unaffected by the contract modification, as the revenue recognized to date and future revenue under the existing contract, being the amounts associated with those performance obligations already completed, is not adjusted. Future revenues associated with the performance obligations remaining under the contract modification will be accounted for separately. Modification not accounted for as a separate contract, P.122. If neither of the conditions for a separate contract is met. How the contract modification is accounted for depends on whether the remaining goods or services to be transferred under the existing contract are distinct from those goods or services that were already transferred before the contract modification. The three accounting approaches are outlined. 1. If they are distinct, the contract modification is accounted for as a replacement of the existing contract with the creation of a new contract. 2. If they are not distinct, the contract modification is accounted for as part of the existing contract. 3. If it's a combination of 1 and 2, the contract modification is accounted for as partly the creation of a new contract and partly modification of the existing contract. IFS 15, para. 21. Step 2. Identify the performance obligations in the contract, P.123. A promise constitutes a performance obligation if it is for the transfer of either a good or service, or a bundle of goods or services that is distinct, or b. a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. IFS 15, para. 22. Provided it is considered distinct, any good or service promised, either explicit or implicit, to a customer as a result of a contract gives rise to a performance obligation. Promised goods or services may give rise to a performance obligation even if the promise is incidental or part of an entity's marketing campaign. For example, free handsets as part of mobile plans. Determining what is meant by distinct, P.124. A good or service is considered distinct when A. The customer can derive benefit from the good or service either on its own or together with other resources that are readily available to the customer. IFS 15, para. 27, A, and B. The entity's promise to transfer the good or service to the customer is separately identifiable from other promises in the contract. IFS 15, para. 27, B. Series of distinct goods and services that are substantially the same and have the same pattern of transfer. P. 125. IFS 15 permits an entity to account for a series of distinct goods or services that are substantially the same and have the same pattern of transfer as a single performance obligation, provided each distinct good or service in the series that the entity promises to transfer to the customer represents a performance obligation to be satisfied over time. The entity uses the same method to measure its progress towards satisfaction of the performance obligation for each distinct good or service in the series. IFS 15, para. 23. As stated, these requirements apply to goods or services that are delivered consecutively rather than concurrently. For example, they would apply to repetitive service contracts such as cleaning contracts. Step 3. Determine the transaction price of the contract. P. 125. A transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amounts collected on behalf of third parties. E.g. GST. IFS 15, para. 47. When determining the transaction price, an entity shall consider the effects of 1. Variable consideration, including any constraining estimates of that consideration. 2. The existence of a significant financing component in the contract. 3. Non-cash consideration. 4. Consideration that is payable to a customer. IFS 15, para. 48. 1. Variable consideration. P.126. The consideration promised in a contract with the customer may include fixed amounts, variable amounts, or both, and the variable amount can be estimated by the entity. Paragraph 51 of IFS 15 specifies examples of when consideration may vary, including discounts, rebates, refunds, credits and price concessions, whether explicit in the contract or implied from an entity's customary business practices, published policies or statements to the customer offered to customers, or incentives or performance bonuses offered to the entity on the occurrence of a future event, or penalties imposed on the entity on the occurrence of a future event. Estimating variable consideration. Expected value method. An entity shall estimate variable consideration using either the expected value or the most likely amount method, and this must be applied consistently throughout the contract. However, an entity is permitted to choose different methods for estimating different types of variable consideration within one contract. Under the expected value method, the expected value of variable consideration is the sum of probability-weighted amounts in the range of possible consideration amounts. The expected value method may better predict variable consideration if the entity has many contracts with similar characteristics. This method requires an entity to identify 1. The possible outcomes of a contract, 2. The probability of each outcome occurring, and 3. The consideration amount it is entitled to under each outcome. The sum of each probability-weighted consideration amount the entity is entitled to under each outcome is the expected value of variable consideration. Most likely amount method. Under the most likely amount method, the expected value of variable consideration is the consideration amount the entity is entitled to under the most likely possible outcome of a contract. This amount is not probability-weighted, rather, an entity determines, from a range of possible outcomes, the outcome that is most likely to occur. This method may be a better predictor of variable consideration than the expected value method if the contract has only 2 possible outcomes. For example, an entity either achieves a performance bonus or not. Constraining estimates of variable consideration. On estimating the amount of variable consideration within the transaction price, an entity needs to consider the likelihood that this amount will be realized. Variable consideration is included in the transaction price only to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty associated with the variable consideration is subsequently resolved. IFS 15, para. 56. If the entity assesses that it is highly probable that including its variable consideration estimate will not result in a significant revenue reversal, the amount is included in the transaction price, and this assessment must be done for each performance obligation that contains variable consideration. Further, the magnitude of a possible revenue reversal should be assessed relative to the total consideration for each performance obligation. At the end of each reporting period, an entity must update the transaction price to reflect the amount of consideration to which it expects to be entitled, and this includes a reassessment of whether the variable consideration is constrained and, if so, by what amount. Significant financing component in the contract. P. 128. The payment of consideration by a customer may not occur at the same time the entity transfers the good or service to the customer, as the consideration may be paid before or after the transfer occurs. When consideration is paid in advance, the entity receives from the customer the benefit of financing the transfer of the good or service. Alternatively, when consideration is paid in arrears, the customer receives from the entity the benefit of financing the transfer. When a contract contains a significant financing component, the entity adjusts the promised amount of consideration, and, therefore, the transaction price of the contract for the effects of the time value of money. Under IFS 15, an entity must assess, first, whether a contract contains a financing component and, second, if it does, whether that component is significant to the contract. This assessment is not required when the period between the entity transferring a promised good or service to a customer and the customer paying for the good or service is 1 year or less. If the assessment is not required, the financing component, if any, is automatically considered to be not significant. IFS 15, para. 63. For those contracts in which the period between the transfer of the good or service and the payment of consideration is greater than 1 year, the entity must consider all relevant facts and circumstances in assessing whether the contract contains a significant financing component. These facts and circumstances include the difference, if any, between the amount of promised consideration and the price that a customer would have paid for the good or service if the customer had paid cash for the good or service at the time of transfer. That is, the cash selling price, the combined effect of 1. The expected length of time between when the entity transfers the promised good or service to the customer and when the customer pays for the good or service, and 2. The prevailing interest rates in the relevant market. IFS 15, para. 61. If the financing component is not considered to be significant, no adjustment is made to the transaction price of the contract. If the financing component is significant, the entity adjusts the amount of the promised consideration for the effects of the time value of money by discounting the nominal amount of promised consideration to the cash selling price at the discount rate that would be used if the entity and customer entered into a separate financing transaction. In effect, if a contract contains a significant financing component, the contract conceptually consists of 2 transactions, one for the exchange of the good or service and another for the financing of that good or service, and thus IFS 15 requires each transaction to be accounted for separately. The entity recognizes revenue from contracts with customers as the portion of promised consideration that equals the cash selling price. The entity recognizes the difference between the nominal amount of promised consideration and the cash selling price as interest revenue if the entity benefits from financing, or interest expense if the customer benefits from financing, recognized in the statement of P&L. Non-cash consideration P.130. When a customer promises consideration in a form other than cash, the non-cash consideration should be measured at fair value according to IFS 13 fair value measurement and included in the transaction price. When fair value cannot be reasonably estimated, the non-cash consideration is measured as the standalone selling price of the goods or services promised to the customer in exchange for the consideration. IFS 15, paras 66 and 67. Consideration payable to a customer P.130. Consideration may be payable by entities to their customers in exchange for a distinct good or service that the customer transfers to the entity, or as an incentive provided by the entity to the customer to encourage the customer to purchase a good or service from the entity, for example a credit, coupon, voucher, or free product or service that can be applied against amounts owed to the entity. Consideration payable to a customer in exchange for a distinct good or service is accounted for in the same way that the entity accounts for other purchases from suppliers. However, when the consideration payable exceeds the fair value of the distinct good or service, the entity accounts for the excess as a reduction of the transaction price owed to the entity. If the entity cannot reasonably estimate the fair value of the distinct good or service, all the consideration payable is accounted for as a reduction of the transaction price owed to the entity. The effect of the reduced transaction price is a reduction in the revenue recognized by the entity. Consideration is considered payable to the customer when the recipient of the consideration is another party that purchased the entity's goods or services from the customer. For example, a car manufacturer that offers consumers 12 months of free car servicing would account for this as a reduction of the transaction price with the car dealer that sold the car to the consumer. Step 4. Allocate the transaction price to each performance obligation P.131. For contracts with a single performance obligation, the allocation process is simple. The entire transaction price relates to the single performance obligation. An entity shall allocate the transaction price to each performance obligation based on the standalone selling price of the distinct good or service. To do this, an entity determines the standalone selling price of each distinct good or service underlying each performance obligation in the contract. Once all standalone selling prices have been determined, the entity allocates the transaction price in proportion to those standalone selling prices. IFS 15, para. 76. The standalone selling price is the observable price at the time of entering into the contract for which an entity would sell the distinct good or service separately to a customer and may be estimated. Under paragraph 79 of IFS 15, the three suitable estimation methods are: 1. Adjusted market assessment approach. An entity evaluates the market in which it sells goods or services and estimates the price customers would be willing to pay for those goods or services, whether provided by the entity or a competitor. Under this approach, an entity focuses on market conditions, including supply and customer demand for the good or service, competitor pricing for the same or similar good or service, and the entity's share of the market. 2. Expected cost plus a margin approach. An entity forecasts its expected costs of satisfying a performance obligation and then adds an appropriate margin for that good or service. Under this approach, the entity primarily focuses on entity-specific factors, including its internal cost structure and pricing strategies and practices. 3. Residual approach. An entity estimates the standalone selling price as the total transaction price less the sum of the observable standalone selling prices of other goods or services promised in the contract. Under this approach, when all but one of the standalone selling prices of promised goods or services is directly observable, the standalone selling price of the good or service that is not observable is the difference between the total transaction price and the sum of directly observable standalone selling prices. An entity, however, may only use the residual approach for a good or service with a highly variable selling price. Otherwise, the selling price is uncertain because the good or service has not previously been sold on a standalone basis. Allocation of a discount, P.132. A discount exists when the sum of the standalone selling prices of the distinct goods or services in the contract exceeds the promised consideration in a contract. An entity must allocate a discount proportionately to all performance obligations in the contract. However, if the entity has observable evidence that the entire discount relates to not all performance obligations in a contract, it will allocate the discount to those specific performance obligations only. The entity has observable evidence when both of the following criteria are met. The entity regularly sells each or bundles of each distinct good or service in the contract on a standalone basis and regularly at a discount to the standalone selling price. The discount in the contract is substantially the same as the discount regularly given on a standalone basis. Allocation of variable consideration, P.133. For example, consider an entity that enters into a contract with a customer to provide two distinct goods at different times, where each distinct good constitutes a separate performance obligation. A bonus is payable by the customer to the entity on timely delivery of the second good, and the bonus constitutes variable consideration, and it would be inappropriate to allocate it to both performance obligations given that it relates to the second performance obligation only. Step 5. Recognize revenue when each performance obligation is satisfied, P.133. Under IFS 15, a performance obligation is satisfied when a promised good or service is transferred to the customer when they obtain control of that good or service. IFS 15, para. 31. According to IFS 15, a good or service is an asset to a customer. The standard states, control of an asset refers to the ability to direct the use of, and obtain substantially all of the remaining benefits from, the asset. IFS 15, para. 33. The benefits of an asset are the potential cash inflows or savings in cash outflows obtained directly or indirectly from the asset. At the time of entering into a contract, an entity must determine whether it will satisfy the performance obligation over time or at a point in time. If a performance obligation will not meet the criteria to be satisfied over time, it is satisfied at a point in time. Performance obligation satisfied over time, P.134. A performance obligation is satisfied over time if one of the following criteria is met. 1. The customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. 2. The entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. Or 3. The entity's performance doesn't create an asset with an alternative use to the entity and the entity has an enforceable right to payment for performance completed. IFS 15, para. 35. If any of these three criteria are met, the entity transfers control of the good or service over time while concurrently satisfying the performance obligation. A transaction price allocated to the performance obligation is recognized as revenue gradually as the performance obligation is increasingly completed over time. Customer simultaneously receives and consumes the benefit of the entity's performance, P. 134. This criterion implies that the entity's performance creates an asset only momentarily, as the asset is simultaneously created, received and consumed by the customer while the entity performs. As such, this criterion applies only to services and not goods, as a customer cannot simultaneously receive and consume a good while it is being produced. For some service-type performance obligations, the customer's receipt and simultaneous consumption of the benefits of the entity's performance can be readily identified. For example, performance obligations for routine services such as cleaning services, IFS 15, para. B3. If it is unclear that the performance obligations have been satisfied, the entity will determine whether another entity would need to substantially reperform the work it has completed to date if that other entity were to fulfill the remaining performance obligation to the customer. If substantial reperformance isn't required, the performance obligation is satisfied over time. IFS 15, para. B4. Customer A controls the asset as it is being created or enhanced. P. 134. Under this criterion, control of an asset is transferred over time if the entity's performance creates or enhances an asset that a customer A controls as the asset is created or enhanced. For example, an entity enters into a contract with a single performance obligation to construct a building on the customer's land and the customer A controls any work in progress as the building is constructed. Because the customer A controls the work in progress, it is obtaining benefits of the goods and services the entity is providing, and thus the performance obligation is satisfied over time. Entity's performance does not create an asset with an alternative use, and the entity has a right to payment for performance completed to date. P.134. This criterion has two components that both need to be satisfied. 1. The entity's performance does not create an asset with an alternative use to the entity. And 2. The entity has an enforceable right to payment for performance completed to date. Alternative use. When the entity's performance creates an asset with an alternative use to the entity could direct the asset to another customer. The customer does not control the asset as it is being created because it cannot restrict the entity from directing that asset to another customer. For example, the production of identical inventory items that the entity can substitute across different contracts with customers. The entity is less likely to have an alternative use for a highly customized asset that is created for a customer as it would incur significant costs to work the asset for another customer or need to sell it at a significantly reduced price. As a result, control of the asset could be transferred over time. Right to payment. An entity has a right to payment if it is entitled to an amount that compensates it for its performance completed to date should the customer or another party terminate the contract for reasons other than the entity's failure to perform as promised. Measuring progress on performance obligations satisfied over time. P.135. IFS 15 specifies two types of methods of measuring progress on performance obligations that are satisfied over time. Output methods and input methods. 1. Output methods recognize revenue based on direct measurements of the value to the customer of the goods or services transferred to date relative to the remaining goods or services promised under the contract. For example, surveying performance completed to date, appraising results or milestones achieved, determining time elapsed under the contract and measuring units produced or delivered to date. IFS 15, para. B15. 2. Input methods recognize revenue based on the entity's efforts or inputs towards satisfying a performance obligation relative to the total expected inputs to satisfy the performance obligation. For example, measuring, to date, resources consumed, labor hours expended, costs incurred, time elapsed under the contract or machine hours used. IFS 15, para. B18. When an entity is closer to completely satisfying the performance obligation than the previous period, the change in the measure of progress is recognized as revenue in the current period. Performance obligations satisfied at a point in time. P.135. If none of the three criteria for recognizing revenue over time are met, an entity must recognize revenue at a point in time when the entity transfers control of the asset to the customer. At the time control is transferred, the performance obligation is satisfied. 3.2. Contract costs. P.136. IFS 15 permits an entity to recognize the following as assets. 1. The incremental costs of obtaining a contract with a customer. 2. The costs to fulfill a contract with a customer. Incremental costs of obtaining a contract. P.136. Under paragraph 91 of IFS 15, the incremental costs of obtaining a contract shall be recognized as an asset if the entity expects to recover those costs. There are two aspects to this recognition requirement. 1. The costs of obtaining a contract are incremental, and 2. The entity expects to recover these costs. Costs of obtaining a contract are incremental if they would not have been incurred had the contract not been obtained. IFS 15, para. 92. While recovery of these costs may be either direct, that is reimbursement by the customer under the terms of the contract, or indirect, that is incorporated into the profit margin of the contract. Costs of obtaining a contract that are not incremental, i.e., costs incurred regardless of whether the contract was obtained, are recognized as an expense when incurred, unless they are chargeable to the customer regardless of whether the contract is obtained up to 1 year. IFS 15, para. 93-94. Costs to fulfill a contract, P.137. If the costs incurred to fulfill a contract are within the scope of another standard, IFS 15 states that an entity shall account for those costs in accordance with that standard. IFS 15, para. 96. If the costs incurred are not within the scope of another standard, an entity recognizes an asset from the incurred costs only if all of the following criteria are met. The costs relate directly to a contract, or to an anticipated contract that the entity can specifically identify, for example, direct labor, direct materials, allocation of overheads that relate directly to the contract, costs explicitly chargeable to the customer under the contract, and other costs that are incurred only because an entity entered into the contract. The costs generate or enhance resources of the entity that will be used in satisfying performance obligations in the future. The costs are expected to be recovered. IFS 15, para. 95. Amortization and impairment, P.137. Amortization occurs on a systematic basis consistent with the transfer to the customer of the goods or services to which the asset relates, and the amortization is for the contract life. IFS 15, para. 99. When there is a significant change in the entity's expected timing of transfer to the customer of the goods or services to which the asset relates, the entity updates the amortization to reflect the change. For example, if the entity renews a contract for an extra period that wasn't anticipated at contract inception, an entity recognizes an impairment loss to the extent that the carrying amount of the asset that is recognized exceeds the remaining amount of consideration that the entity expects to receive in exchange for the goods or services to which the asset relates, less the yet to be incurred costs that relate directly to providing those goods or services. IFS 15, para. 101. 3.3, Disclosure, P.138. Contracts with customers, P.138. An entity must disclose disaggregated revenue from contracts with customers, contract balances, performance obligations and the transaction price allocated to remaining performance obligations. Disaggregation of revenue, P.138. Under IFS 15, an entity must disclose revenue recognized from contracts with customers that has been disaggregated into categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors. IFS 15, para. 114. Examples of this disaggregation includes A. Type of good or service, for example, major product lines. B. Geographical region, for example, country or region. C. Market or type of customer, for example, government and non-government customers. D. Type of contract, for example, fixed price and time on materials contracts. E. Contract duration, for example, short-term and long-term contracts. F. Timing of transfer of goods or services, for example, revenue from goods or services transferred to customers at a point in time and revenue from goods or services transferred over time. And G. Sales channels, for example, goods sold directly to consumers and goods sold through intermediaries. IFS 15, para. B89. Contract balances, P.138. In relation to contract balances, an entity must disclose all of the following: the opening and closing balances of receivables, contract assets and contract liabilities from contracts with customers, revenue recognized in the reporting period that was included in the contract liabilities opening balance, revenue recognized in the reporting period from performance obligations that were either completely or partially satisfied in previous periods. IFS 15, para. 116. A contract liability arises when an entity has received consideration or has an unconditional right to receive consideration from the customer before the entity transfers a good service to the customer. The unconditional right to receive compensation from a customer constitutes a receivable. This is distinct from a contract asset, which is A. An entity's right to consideration in exchange for goods or services that the entity has transferred to a customer when that right is conditioned on something other than the passage of time. For example, the entity's future performance. Disclosures about an entity's contract balances help users understand the relationship between the revenue recognized and changes in the balances of an entity's contract assets and liabilities during the reporting period. For example, disclosing the opening balances of contract liabilities will help users understand the amount of revenue that will be recognized during the current period, while disclosing the opening balances of contract assets will provide them with an understanding of the amounts that will be transferred to accounts receivable or collected as cash during the period. Performance obligations, P.139. In relation to performance obligations, an entity must disclose a description of all of the following: when the entity typically satisfies its performance obligations, for example, on shipment, on delivery, as services are rendered or when they are completed. The significant payment terms, for example, when payment is due, whether the contract includes a significant financing component, and whether the amount of consideration is variable, or its estimate is constrained. The nature of the goods or services that the entity has promised to transfer. Obligations for returns, refunds and other similar obligations. Types of warranties and related obligations. IFS 15, para. 119. Transaction price allocated to remaining performance obligations. P.139. The final disclosure requirement related to contracts with customers requires an entity to disclose the amount of the transaction price that is allocated to the unsatisfied performance obligations in a contract, whether partial or complete, at the end of the reporting period. An entity must provide an explanation of when it expects to recognize as revenue the transaction price allocated to the unsatisfied performance obligations, and can be either quantitative, for example, amounts to be recognized as revenue according to specified times, or qualitative, IFS 15, para. 120. These disclosure requirements provide users with information about the amount and timing of revenue that an entity expects to recognize from the remaining performance obligations in its existing contracts with customers. IFS 15 basis for conclusions. Para. BC 350. Significant judgments in the application of IFS 15 revenue from contracts with customers. P. 140. An entity is required to disclose and explain the judgments and changes in judgments used to determine the timing of satisfaction of performance obligations. Transaction price and amounts allocated to performance obligations. IFS 15, para. 123. Assets recognized from contract costs. P.140. For assets recognized from the costs to obtain or fulfill a contract with a customer, an entity must provide a description of the judgments made in determining the amount of the costs, and have the amortization method used for each reporting period. Disclose the closing balances of the assets recognized. Disclose the amount of amortization and any impairment losses recognized in the reporting period. IFS 15, paras 127 and 128. Part B, Provisions. P.142. Scope of IAS 37 Provisions, Contingent Liabilities and Contingent Assets. P.142. IAS 37 applies to all provisions, other than those that result from executory contracts, except for onerous contracts, are covered by another standard. IAS 37, para. 1. Executory contracts are contracts under which neither party has performed any of its obligations or both parties have partially performed the obligations to an equal extent. IAS 37, para. 3. Definition of provisions. P.143. A provision is defined in IAS 37 as a liability of uncertain timing or amount. IAS 37, para. 10. And a key aspect of this is the requirement that uncertainty exists. For a present obligation to exist, the entity must have no realistic alternative to settling the obligation created by the event. IAS 37, para. 17. When there is a significant level of certainty, the amount is not recognized as a provision, but is a liability. For example, liabilities are borrowings, trade creditors and accruals. In cases where the degree of uncertainty in relation to the timing or amount of the liability cannot be measured with sufficient reliability, the amount is classified as a contingent liability. Provisions are liabilities of uncertain timing or amount. IAS 37, para. 10. Whereas contingent liabilities arise where the degree of uncertainty in relation to the timing or amount of the liability cannot be measured with sufficient reliability. IAS 37, para. 12. 3.4. Recognition of provisions. P.143. IAS 37 requires the following conditions to be met for a provision to be recognized. A. An entity has a present obligation, legal or constructive, as a result of a past event. B. It is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. And C. A reliable estimate can be made of the amount of the obligation. IAS 37, para. 14. Criteria for a present obligation. IAS 37, para 17, 1. Legally enforceable. 2. A duty or responsibility. 3. A third party is owed something. Present obligation in past event. P.143. The standard setters believe that it will normally be clear whether a past event has given rise to a present obligation that should be recognized in the statement of financial position. An obligation is a duty or responsibility that an entity has no practical ability to avoid. Conceptual framework, para. 4.29, and is legally enforceable due to a binding contract or statutory requirement. The most common form of present obligation is a legal obligation, in which an external party has a present legal right to force the entity to pay or perform. However, it may also be a constructive obligation to the extent that there is a valid expectation in other parties that the entity will discharge the obligation. For example, a manufacturer provides warranties at the time of sale to purchasers of its product lines, and under the warranty, the manufacturer undertakes to repair or replace items that fail to perform satisfactorily within 2 years from the date of sale. As such, the present obligation as a result of a past event occurs when on the date of sale, which gives rise to a legal obligation from the sale date to honor the warranty in the event of fault. A constructive obligation derives from an entity's actions where a. By an established pattern of past practice, published policies or a specific current statement, the entity has indicated to other parties that it will accept certain responsibilities. And b. As a result, the entity has created a valid expectation on the part of those other parties that it will discharge those responsibilities. ES 37, para. 10. The definition of a present obligation includes liabilities arising from normal business practice or custom, a desire to maintain good business relations or a desire to act in an equitable manner, e.g. habitually providing staff with bonuses, but not from a contractual agreement with another entity. Probable outflow of economic benefits, P.144. This occurs when the probability that the event will occur is greater than the probability that it will. Note, ES 37, para. 23. Where there are several similar obligations, for example warranty obligations, the class of obligations is considered in determining whether an outflow of resources is probable. ES 37, para. 24. Reliable measurement, P.144. Consequently, a provision is capable of being reliably measured even if several possible outcomes exist. 3.5. Measurement of provisions, P. 145. The amount recognized as a provision shall be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. ES 37, para. 36. The best estimate is the amount that an entity would rationally pay either to settle the obligation at that date or to transfer it to a third party at that time. When measurement uncertainty exists, the provision amount should be estimated based on its circumstance, but measurement uncertainty does not suggest that no provision is required. The estimation requirements differ depending on whether the provision involves a large population of items or a single obligation, including where the provision being measured involves a large population of items. The obligation is estimated by weighting all possible outcomes by their associated probabilities. The name for this statistical method of estimation is expected value, ES 37, para. 39. Where a single obligation is being measured, the individual most likely outcome may be the best estimate of the liability, ES 37, para. 40. The most appropriate estimate of the provision is determined by using the judgment of the management of the entity, supplemented by experience of similar transactions and reports from independent experts. The evidence considered includes any additional evidence provided by events after the reporting period. ES 37, para. 38. Discounting, P.146. Consequently, provisions are discounted when the effect of this discounting is material. The discount rate should be a pre-tax rate that reflects current market assessments of the time value of money and the risks specific to the liability, and should not reflect risks already accounted for in cash flow estimates. ES 37, para. 47. When the use of economic resources depends on technology, for example for cleaning up a site in the future, the estimated amount should be based on the current, not future technology. ES 37, para. 49. In order to account for this changed risk, the firm may either adjust the future cash flow estimates or adjust the discount rate to reflect this. E.g. The journal entry to unwind a discount for an environmental provision is Dr. Environmental Provision Expense, PL. CR Environmental Provision, Liability, BS. 3.6. ES 37 Provisions, Contingent Liabilities and Contingent Assets, Disclosure, P.147. Provisions, P. 147. When there is a possible obligation whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. The possible liability must be disclosed in the financial statements as a contingent liability, as the possibility of an outflow in settlement is more than remote. The key disclosures required by ES 37 relating to provisions are: for each class of provision, an entity shall disclose A. The carrying amount at the beginning and end of the period. B. Additional provisions made in the period, including increases to existing provisions. C. Amounts used, that is incurred and charged against the provision, during the period. D. Unused amounts reversed during the period. And E. The increase during the period in the discounted amount arising from the passage of time and the effect of any change in the discount rate. An entity shall disclose the following for each class of provision: A. Brief description of the nature of the obligation and the expected timing of any resulting outflows of economic benefits. B. An indication of the uncertainties about the amount or timing of those outflows, and where necessary to provide adequate information, an entity shall disclose the major assumptions made concerning future events. And C. The amount of any expected reimbursement, stating the amount of any asset that has been recognized for that expected reimbursement. ES 37, paras 84 and 85. Exemptions, P.149. An exemption from ES 37 can be when disclosure of some or all the information required can be expected to prejudice seriously the position of the entity in a dispute with other parties on the subject matter of the provision. Contingent liability or contingent asset, ES 37, para. 92. 3.7. Provisions and professional judgment, P.149. The need for professional judgment in determining whether an obligation constitutes a provision introduces discretion and subjectivity into financial reporting, which creates potential pressures from management for the accountant to manipulate reported accounting numbers, including engaging in earnings management. For example, distinguishing feature between provisions and other types of liabilities, such as trade payables, is the degree of uncertainty in the timing or amount of the obligation. Part C, Contingent Liabilities and Contingent Assets, P.151. 3.8. Contingent Assets, P.151. A contingent asset is defined in ES 37 as a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. ES 37, para. 10. For example, a claim an entity is pursuing through legal processes with an uncertain outcome. ES 37, para. 32. Contingent assets and contingent liabilities are disclosed in the notes to the financial statements. If the flow of economic benefits is greater than 50%, then it is considered probable, but if it is greater than 90%, it is classified as virtually certain, whilst, if it's deemed not probable, then it is less than 50%. 3.9. Contingent liabilities, P.152. Contingent liabilities are a present obligation, where the outflow of resources in the future is not probable. ES 37, para. 10. B.I. Contingent liabilities are defined as a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. Or B. A present obligation that arises from past events but is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation. Or 2. The amount of the obligation cannot be measured with reliability. ES 37, para. 10. The contingent liability must be disclosed when a. the occurrence of an event has resulted in probable sacrifice of future economic benefits, but the amount can't be reliably measured. B. As a consequence of the event, a present obligation exists but the future sacrifice of economic benefits is unlikely. The ability to reliably estimate the amount of a present obligation can be the difference between recognizing a provision and disclosing a contingent liability. If a liability asset satisfies one criterion of the recognition criteria in that it can be reliably measured but fails the other in that the inflow of economic benefits at year-end is not probable, then no action should be taken by the entity. From paragraph 10 of ES 37, a contingent liability will exist in the event of 1. A possible obligation to be confirmed by uncertain future events. 2. A present obligation where the future sacrifice of economic benefits is not probable. Or 3. A present obligation with a probable future sacrifice of economic benefits that is not reliably measurable. It is only when the probability of future sacrifice is higher than remote that the contingent liability will be disclosed in a note to the financial statements. Liabilities versus contingent liabilities, P.154. When it is determined whether a liability or a contingent liability exists, it will normally be clear whether a past event has given rise to a present obligation. Where the existence of a present obligation is still unclear, and this will only be confirmed by the occurrence or non-occurrence of some future event outside the control of the entity, a possible obligation is identified and treated as a contingent liability. 3.10. Contingencies and professional judgment, P.154. An accountant must exercise professional judgment in determining whether an item should be recognized as a financial statement element or whether it constitutes a contingency. For example, an accountant must assess whether, after all available evidence has been considered, if an asset exists. An accountant must decide whether an obligation is a possible or present obligation, and if it is a possible obligation, a contingent liability exists and must be disclosed. If it is a present obligation, the accountant must determine whether an outflow of resources is probable and whether the amount of the obligation is reliably measurable. When a contingency is required to be disclosed, an accountant must also exercise discretion in deciding the extent to which potentially sensitive information is made public. For example, an entity subject to a strong legal claim that has been brought against it, where the outcome is uncertain, has a contingent liability.